Hello, John Siegel here, Senior Wealth Manager for Willis Johnson & Associates. I'm here to talk about our BP stock outlook. We work with a lot of BP professionals and executives. For many of our clients, they have a lot of BP stock, from the BP Share Value Plan, in the BP Stock Fund in the 401k, or just from straight purchase. So I want to talk a little bit about that and talk about our outlook on BP stock going forward and what you should be thinking about with BP stock in your portfolio. A common thing we see is that people that work with BP have a disproportionate amount of their portfolio invested in BP stock. Not surprising. We see many people who are knowledgeable of a company or an industry have an investment focus in that company or in that industry. If we look at national averages, people that live in the southern U.S. where larger utility and energy companies are located, they tend to have 14% more than the national average in energy and utility stock. 14% more. Now, does that mean it's because people in the South have a better risk-return profiles having energy? No. In fact, a lot of energy stocks did not deliver exceptional return over the last decade. Only recently have we seen some more exceptional returns from energy stock. But what about the risk? The risk of having BP stock if you are a BP employee. If you think about it, your base, your bonus, the share value plan shares, your benefits, those are all tied to BP. A common investment principle deals with the risk inherent in owning a lot of stock in one company. That's called stock concentration risk. Well, if we think about this concept one step further, with BP stock, you can have a lot of financial concentration risk by having a lot of stock in the company from which you derive your income and your benefits. This is why we pay attention to the company stock holdings of our BP clients. So if we look at BP stock compared to some of the major oil and gas companies over the last 3 years, BP is up 58%, or 16.5% annualized. Now, of course, that is starting during the economic doldrums of the pandemic. So there is some recovery built into that return. Still, that 16.5% annual 3-year return is better than the S&P 500, which delivered 9.66% over the same period. However, it trails its competitors. Chevron up 19.5% annually. Shell up 25% annually, and Exxon up 30% annually. So BP has outperformed the major index for the stock market, but it trails in the oil and gas sector. Why? Well, one thing that many people look to is the reinvent strategy launched by company leadership in late 2020. This strategy calls for the company to be carbon net neutral by the year 2050 and to cut oil and gas output by 30% by the year 2030. This is a bold strategy, and certainly it coincides well with the growing presence of renewable energy sources, electric cars, and a growing concern about global warming. But it is not impressing investors. Investors want a clear sense of profit potential, and BP trimmed its upstream operations like some of its Alaska assets or its refining properties in Texas City and Toledo. Investors lose sight of where the profit potential lies. This reinvent strategy comes at a time when we're seeing a big upswing for U.S. oil and gas production. Russia's market for oil and gas has been limited by its international isolation after its invasion of Ukraine, and OPEC has been cutting its output in an attempt to level the overall crude pricing. However, the U.S., along with Brazil and Guyana, are growing production to meet growing demand. Demand is leveling in the U.S. This has to do with greater energy efficiencies, the greater use of renewables, and some other factors. However, look at the big rise in demand on the other side of the globe from the U.S. There is a significant rise in demand from India, where the economy is growing quickly, and from China. This increase from China is at a time when GDP growth there is at about 3%. Imagine how energy demand from China might pick up if its GDP growth begins to track closer to the 6% where it was just a few years ago. In recent weeks, we've seen big gains in crude and natural gas prices after a brief weakening. Overall, we are seeing big growth trend for oil and gas. And BP is part of that growth, but its carbon net neutral strategy has clouded its connection to that growth for many investors. Also, BP has had a leadership shakeup with the departure of its CEO, Bernard Looney. This has also given investors pause. The new leadership, under Murray Auchincloss, has stated that it is staying the course with the reinvent strategy so far, but it has lowered some of the targets. For instance, cutting oil and gas output by 25% by 2030 instead of the original goal of 30%. But here's the reality. BP is not getting smaller. Its market cap remains about the same. But it's not seeing its market cap grow like its competitors, where Exxon has a market cap of over $500 billion and Chevron has a market cap of almost $300 billion. Shell and Total are also growing their market cap. BP is holding steady at around $100 billion, while investors are looking for growth. Additionally, BP's debt-to-equity ratio is much higher than its competitors, over 5 times that of Chevron, for example. That has drawn attention from market analysts and prompted a downgrade in BP's credit outlook by Standard & Poor's. In all of this, though, BP is making money. 2023 was its most profitable year since 2013. And while the first quarter of 2024 profits were disappointing, about 1/4 of what they were in the first quarter of 2023, and some of that is due to some write-offs, its overall profit margins are positive. Again, we have not seen a significant growth in BP's stock price in the last few years compared to the stock of BP's competitors. But that renders an interesting investment dynamic for BP. Its price-to-earnings ratio is much lower than its competitor companies in oil and gas. That could show that BP is relatively underpriced. However, it can also be an outgrowth or a sign of the investor concerns in the stock. And the company is looking to shore up its stock price with billions in share buybacks. That could be a beneficial buy or hold strategy in the short term. So what does this all mean for you? If you are a BP professional who may be holding a lot of stock in the company, who may be getting more stock through the share value plan in coming years, who will have reinvent stock options vesting in March of 2025? Well, the answer can vary. What kind of diversity do you have in your overall portfolio? What percentage of BP stock comprises your overall portfolio? Do you have a plan for managing your future vesting in BP stock? Now, as I mentioned a few minutes ago, we see not just stock concentration risk in holding a lot of BP, but we see financial concentration risk in holding BP while you are still working for the company, which provides your paycheck, your benefits, your 401k match, and your wrap pension. It is a healthy thing to diversify away from financial concentration risk. And there are ways to maintain some upside in the energy sector while doing so. We also see some potential opportunity for income tax leverage in reducing BP stock holdings. That's why we advise our BP clients to manage their concentration in BP stock and help them execute effective plans for doing so. Whether you align with the broad investor hesitations about BP stock or are optimistic about its future in more renewable energy sources, the issue for you remains the same. The financial risk in having a significant concentration in stock of the company for which you work and from which you derive your other financial benefits is significant. I'm John Siegel. Thanks again for checking in. Please be sure to hit the subscribe button if you desire to keep abreast of our updates on BP stock and the many other insights we provide on the company and its benefits. Take care.